APR is a calculation defined by federal regulation to estimate the long-term cost of a mortgage. To learn more, stick around after this. I'm Dan Green with homebuyer.com. My MLS is 227607. Our lender MLS is 423065. We're part of Novus Home Mortgage, a division of Exonia Bank. You can read more about homebuyer.com in the video's description, including our lending coverage and some very important disclaimers. Also, don't forget to hit the subscribe button because this channel is full of excellent mortgage video. And I'm a mortgage guy. Talk to a separate licensed expert for your legal, tax, and financial advice. This video is about APR. Let's jump in. APR, it stands for annual percentage rate. It is a government calculation meant to estimate the cost of paying a mortgage loan to term all the way to its end, so homebuyers can understand what their mortgage actually costs them. This means APR is not an interest rate because the interest you pay for your mortgage, that's only a portion of what your mortgage costs overall. APR, rather, it's a cost calculation. It includes the interest you pay and also your closing costs, such as discount points or lender fees, your projected mortgage insurance premiums, if your mortgage requires you to have private mortgage insurance, and any prepaid mortgage interest that you pay. APR takes all these costs related to your mortgage, it adds them up, and then it works backwards to find what would your borrowing cost, what would your interest rate have been if you paid that amount, that sum of all your costs to pay off your mortgage, and you started with this amount. So your starting loan size. That's what APR tells you. It is the actual cost of borrowing to the full term of your mortgage to pay off your house in full. And it is an excellent number in theory and theoretically great for comparing two or more offers from two or more lenders. But in real world scenarios, APR can sometimes be less helpful because it relies on multiple assumptions that may not match your actual circumstances. The most obvious assumption that APR makes is that you're going to hold your mortgage to its full and complete term, which according to HMDA data, more than 90% of home buyers, they choose a 30-year mortgage. The APR may assume a 30-year mortgage, and that's fine, except not many people keep their 30-year mortgage for a full 30 years. There was no specific studies that showed how long homeowners keep their original mortgage. I gathered some data from Freddie Mac, from the Urban Institute, from Black Knight. I analyzed it, and what it appears is that fewer than 1 in 10 homeowners will keep a 30-year mortgage for 30 years. Most people sell their home early or they refinance. And those actions, selling or refinancing, or even making an extra payment to your mortgage lender that shortens the loan's duration, those moves adjust APR math. So for most people, other than that 1 in 10, APR may be less effective as a cost comparison tool. But APR makes other assumptions too. For example, if your mortgage requires private mortgage insurance until your home has 20% equity, your APR is based on estimates of when your PMI will be canceled. Now that's an attempt to predict the future. Your lender doesn't know how your home value is going to change over time, so your lender can't know when your PMI will be gone. Again, this adjusts the APR math, okay? Third, if you have an adjustable loan, and remember, APR, it's adding up all of your future mortgage payments. That means that APR, again, becomes speculative based on the lender's guess of how your loan will adjust in the future. Lenders can't know that, but they're still required to make that guess and include those adjusting payments in your APR. There's more. APR is also affected about whether your mortgage includes discount points. Discount points, those are upfront fees that you pay at closing, and they're meant to lower your mortgage rate. You can pay 1 or 2 or 3 discount points if you want. You can pay 0. It's something discussed with your lender. But long-term discount points, they save you money. But that's because your interest rate drops and you spread that out over 30 years. Eventually, you recoup that upfront cost. But the upfront cost can be huge. Each point costs 1% of your loan size. So loans with a lot of discount points, high upfront costs, they actually can have very low APRs. It doesn't mean you're getting a better deal. It just means you have a lower APR. Low APR doesn't always mean a better deal, and a high APR doesn't always mean a worse one. So that's why it's important to remember that APR is not your interest rate. Your interest rate is your interest rate. APR can be a fine comparison tool, but your circumstance may vary. Always talk to a trusted lender to understand your terms. I'm Dan with homebuyer.com. Remember, pre-approved buyers do better. Happy home buying.